6 facts that explain why your backtesting is sabotaging your trading success. Here are the limitations of manual backtesting you need to know. I'm Manir, also known as Ghostwalk Trades on Twitter, and I also run Unbiased Trading, an agency where you can get your strategy backtested and automated. Now, number one is the biases. I reference a paper here called Hindsight Doesn't Equal Foresight, basically the effect of outcome knowledge on judgment under uncertainty. It notes pretty much the brain often succumbs to the cognitive biases. One example, especially in manual backtesting, is the hindsight bias, leading to inaccurate backtests. Pretty much a lot what this paper goes into is really how that even if you have and you know what cognitive biases are, it's very hard for the brain to overcome them when you're the one inflicting them yourself. For example, someone else looking at you would be able to clearly see, oh, he's falling victim to this bias, but you personally knowing that is very difficult to do. And pretty much the whole study just goes through that, like even people that have been previously told before a test that, hey, you know already this knowledge, you've already seen the test, all these sort of things, and you can't take that into account, they still do take it into account when they're actually doing the test and things like that. It goes through different sort of examples, but it's pretty much the overall, I guess, overview of the paper or the main takeaway, and especially in backtesting. So personally, when I hear someone say, hey, I've done this manual backtesting, I've been super vigilant around it, I think it's like, 100% accurate or whatever, I pretty much would never believe that. And it's at no fault of the actual persons themselves. I've done manual backtesting as well back in the day. I just have never been able to see someone reliably do it. And especially the most important part is just not scalable at all. We'll actually get into this a bit further down. But definitely the whole purpose of a backtest is for it to be as accurate as possible as the actual conditions you're going to be trading. So if you already have biases coming into that, and it's not something that could be, proactively fixed easily, then for the most part, this is probably the biggest reason why I'd say manual backtesting has this huge limitation, which can really sabotage your trading success. Two is the inconsistencies. So you may unknowingly alter your decision criteria based on your recent market events or by simply entering the wrong number. This retroactiveness undermines the reliability of manual backtesting, skewing the performance of the strategy historically. This is kind of just touching on the point that I think many people could probably relate to this. Let's say you've got an Excel sheet, you've been going through it, you're manually entering every single trade, you're manually entering the profit, everything like that. Over time, that can easily skew to where, hey, the past, 7 trades didn't work because I did this condition and this condition. I'm speaking very vaguely here, but give or take, as you're going through this manual backtesting, whatever your criteria are, let's say if you're looking at pivots, you could say, actually, that pivot doesn't qualify for my particular strategy, and you just kind of move on and don't take that trade historically, and then you go to the next one that you think, hey, that actually probably would work. That isn't going to be very reliable when you're actually putting that into live action because of all those little changes, maybe the wrong number you entered on Excel. Those things add up over time, and it's similar to what coders call as like technical debt. This is kind of like backtesting debt in the sense that you've just been inaccurate because of manual backtesting, and then when you actually get to that final result of that backtest, realistically, it doesn't mean much because it's quite inaccurate overall. Now, obviously, no one wants to have to deal with that, and it can be super difficult to quantify a strategy and everything like that. That's primarily why I created Unbiased Trading, to really try and help solve these problems for traders that aren't able to properly quantify or backtest their strategies, and then they can actually go into automation from there as well, because obviously you need a solid backtest, and then you can reliably go into that automation side of things where you can run maybe an algorithmic portfolio similar to what I do. Now, 3 is scalability. So manual backtesting is extremely time consuming, limiting scalability and making it nearly impossible to test multiple strategies efficiently. The longer one spends manual backtesting, the higher the risk of errors, compromising results further. The point of this graph is really to demonstrate that how as you spend more time doing something manually, the higher the risk is of you actually having inconsistencies or errors within your work. So if you're backtesting 3 strategies and you're doing an 8-hour, 12-hour session, whatever, trying to do backtesting, you're going to have way more errors as it comes up to that 7 hours, 8 hours in. Or for some people, I think the statistic is most people only have about 4 hours of really solid cognitive time where you can do really good problem solving, and then it kind of diminishing returns after that. So for the most part, if you're kind of going into that 4-hour mark, after that time, that error rate's going to be a lot higher, which is obviously going to lead to the other 2 issues we've mentioned, which was inconsistencies and the biases. Number 4 is reproducibility. The manual backtests are hard to reproduce accurately, leading to inconsistent results that undermine strategy validation. If errors arise, repeating the entire backtest is very time consuming and makes it difficult to iterate and improve a strategy on. Now, obviously, this goes into the topic of overfitting and reworking a strategy too many times, but many of the times, if I have a strategy, I may want to check out and see how it performs if I add maybe one more indicator to it, for example, or if I do maybe one logic change. Now, If I'm doing that manually, I'm going to have to go back through the whole thing and adjust it based on that particular variable that I want to introduce. Whereas in code, yes, you may have to add a piece of code that could maybe take you a couple hours, for example, depending on complexity, but you wouldn't have to spend that whole time manually backtesting it again. You would simply just have to click run again and wait however long it would take for that backtest to run, whether that be in Python or, in a platform like NinjaTrader, for example. So that reproducibility of being able to look and see, hey, look, it performed like this with this particular criteria. I've changed it slightly, and let's see how it performs now. And then additionally, you don't have to manually backtest it again when you're comparing it on new sets of data or new markets. The reason being there is if you already have the code, it's the exact same code running over. You just have to change either the data input, which would be the market, or you have to change the start and end date. That's pretty much it. And you get to save all that time to be able to produce those backtests again and see how it works maybe across different markets and things like that, which can build a really better diversified portfolio of strategies. 5 is statistically significant. With manual backtesting prone to errors and inaccuracies, all manual backtests would not really be qualified as significant. Even disregarding this, basically let's say a manual backtest is perfect and there's no errors or anything like that, most fail to go through enough data where it would actually be adequate sample size. Because of the time-consuming side of manual backtesting, if you're going to try and get, let's say, 5 years of data or, let's say 1,000 samples, that's going to take a lot of time. So even if, let's say, there was no inaccuracies or anything, that's a huge opportunity cost there to spend that much time to be able to get, statistically significant results. Now, if you're wondering why does it have to be statistically significant, a lot of trading is all about probabilities, and a key part of that is making sure that they are actually significant. Pretty much summed down, what significant really means is you have enough data there to actually show that there is, to ideally show either a correlation. Most of the time, it doesn't exactly mean causation, but you at least want to see some sort of correlation with your data, especially if you have enough sample size. That is way stronger proof that, hey, there's something there. So very easy example, let's say a strategy has 10 trades over the past 3 years, and it's got a 90% win rate, it only lost once. Personally, for me, that doesn't really mean much. There's only 10 trades, extremely small sample size, and you could have overfitted that a ton, most likely, to only have it to have 10 trades. Or realistically, I just not seeing enough trades there to actually have enough data to be able to get solid, average statistics for it. Compared to, let's say I have a strategy that has 2,000 trades and the average win rate is 55%, that 55% I'm going to be a lot more confident on, just because there's a huge amount of data showing me, hey, over 1,000 trades, I could split this up, I could do out of sample testing, all these sort of things to get even more validated answers. Whereas if I only have 10 total trades, there's not much I can really do there at all. 6 is lack of complexity. With manual backtesting, it is hard to account for some of the complexities in modeling a strategy historically. Whether it's the complex nature of the strategy itself, whether it be slippage or the impact of your size on the market, leading to less accurate results. I think this is a really key point, at least for me personally, is when I tried to do manual backtesting in the past, because of how time consuming it is and because of all the other points we've really mentioned here, once you've done that initial backtest, you think that you have put in enough effort to where, hey, that initial backtest showed me this result, I'm going to use the strategy and assume this result is super valid. For the most part, at least from nowadays, most backtesting, I would say, takes about 5 steps or so. You really want to be doing multiple tests. To name a few, you want to be doing Monte Carlos, you want to be doing parameter sensitivity, out of sample, walk forward optimization, all these different kind of techniques, which can give you more conviction and more accurate examples of if the strategy would survive on live markets. You can't really do that with manual backtesting. I've never seen someone pull off, walk forward optimization with manual backtesting. And I don't think it's really feasible for most traders to do that. And I wouldn't ever really incentivize to actually do it. The amount of time you're putting into that is huge opportunity cost, and also the inaccuracies of it are going to be very prone when you're doing something, I guess, that more complex when you're doing it manually. All these things lead back to having either some sort of platform or code or something that's reproducible to be able to do backtest correctly. There's tons of services out there, whether it be downloading data and then you put things for Excel. You wouldn't be able to do the most complex stuff, but it's a lot better than doing manual backtesting, in my opinion. And then you can go with platforms like NinjaTrader 8, or if you need something custom or you need a coder, then you could reach out to someone like myself or another person that's providing that coding service that's also a trader. Now, this whole post, I know I'm talking very poorly on manual backtesting, but it isn't all bad. It's ideal for quick checks on strategy recent performance before investing time or resources into a coded backtest. It's also sometimes the only option for strategies lacking historical data. However, it does raise the question of viability. I think this was not properly explained on my tweets. I always do these videos to help flesh them out a bit more. When I say it raises the question of viability, if you have a strategy where there's no historical data on it, it does pose the question that should you even be looking into that strategy? Like many, quantitative hedge fund managers like Jim Simons and others have always said, the main things they look for is that it has liquidity and they can actually model over it, right? And that there's data there to actually look over. Because while, historical performance is not a guarantee of future results, it's one of the best predictors we have currently. So a lot of times when you're trying to be more systematic or algorithmic, you're really looking for that historical data to be able to prove to some essence of that strategy's reliability, and then be able to take on live markets and actually risk your own capital or live capital. But bringing back to the first point, I would say a manual backtest is totally fine if you're just getting into trading or you want to do a quick check, and you're a good Excel whiz or you use Google Sheets or something like that. You can just put in your trade entries and trade exits and the profit you'd think you'd make and things like that, and you can get at least an idea for what the strategy has performed recently. But realistically, I'd say 30, maybe 60 samples in an Excel sheet to get you some recent performance to see has it been performing recently quite well. Should this be something I look into further? I'd say gives you a good ground to look at those performance metrics and things like that manually. Just always keep in mind there's probably going to be some inaccuracies, so it may not match perfectly when you actually do a coded one, for example, but it's going to be a really good initial overview of like, hey, should I spend more time on this? It's something I personally still do. Not every strategy that I think of can be coded really quickly. Most of the time I try and think of simple strategies, but if it's something more complex that maybe would take me a couple days to code, then I might just do a quick manual one just to look over some previous charts, or if I'm live tracking it, something like that. And that might save me some time, because if I have that all logged down, then I can see, oh, actually it hasn't performed well, and it was just my recency bias, me thinking that it performed really good because I saw it perform amazingly on one trending day, for example. Now, if you find this sort of content helpful, feel free to follow me on Twitter, which is GhostOrgTrades, or feel free to subscribe as well. Have a great rest of your day.